Okay, we've only got one learning objective for this module. Explain special considerations when evaluating the credit of sovereign and non-sovereign government debt issuers and issues. Part of assessing the creditworthiness of governments to pay their debt is to understand why they issue debt. Typically, it's issued to conduct fiscal policy or meet budgetary needs. This is the more dangerous one. When we're looking at the creditworthiness of a government is if they're issuing debt just to meet their operating expenses. That is not very sustainable. If they're issuing debt to reinvest in things like infrastructure, that is sustainable because that raises the productivity of the economy. But if you're just meeting your day-to-day needs and you have to issue debt to do that, at some point you're either going to have to involve some form of austerity or face some kind of credit realization on your debt. Repayment can come from taxes and other government revenues. Other government revenues are fees for certain things, tariffs for incoming products and services, and profit from state-owned companies. In developed markets, we typically refer to government debt as default risk-free. It's not that it's risk-free in the sense that government debt is free from all risks. It has inflation risk, it has interest rate risk. When we use the term risk-free, we are particularly paying attention to the word default. It is default risk-free. Emerging and frontier markets, they do involve some default risk, also referred to as credit risk. Let's look at some qualitative factors in assessing different sovereigns for their creditworthiness. Government institutions and policy. Here you're looking at political and economic stability, the rule of law, particularly the protection of property rights. Does that country or that sovereign have a culture of debt repayment? And is there an absence of conflict? And for corporations, we really spend a lot of time assessing their ability to service their debt. With governments, you have to include the willingness to pay as well, because some governments may be unwilling to pay their debt, especially their external debt. They may get to a point where they say, well, what does it matter? We're going to default on our external debt. Who cares? Because it's harder to get a government to pay than it is to get a corporation to pay. It's harder to force a government to declare bankruptcy. It's harder to force them to sell assets. And they know that. So because of that, we have to assess not only their ability, but also their willingness to pay their debt. So in reference to what I said on the previous screen, there are limitations in forcing a government to declare bankruptcy or sell assets. This has a term, it's called sovereign immunity. It limits, it doesn't eliminate, it limits the legal recourse of bondholders. There's still some legal recourse, but it's a much longer road and a much harder fight than if it were a corporation. So it doesn't eliminate recourse, but it does limit recourse, makes it rather expensive. Next, fiscal flexibility, and I wish developed nations, sovereigns would follow this a little bit more. Discipline over time and under different economic scenarios. So what you want to see, and we'll draw out a stylized business cycle, is when you have expansions, you end up with a fiscal surplus. And when you have contractions, you end up with fiscal deficit. And you use surpluses and deficits to conduct fiscal policy. But what we have, or what we've had for, I think, the last 20 years, is in good times, governments run deficits. In bad times, governments run deficits. In low growth times, mediocre times, governments run deficits. There is no fiscal flexibility. It is just constant fiscal budget deficits. So we're not seeing discipline over time and under different economic scenarios. Monetary effectiveness. And this depends on the level of independence of the central bank. Turkey doesn't have a lot of independence. Erdogan pretty much decides what it's going to be, and that's it. Whereas the U.S. has a lot of independence that no matter what Congress thinks, the Federal Reserve will do what it has to do to satisfy its dual mandates. Does the economy have a record of sustainable growth with price stability? And if so, then you can say that there is effective monetary policy and the central bank has credibility. Economic flexibility. What is the size of the economy, the level of per capita GDP? This is important here. The degree of diversification and integration. Diversification means you are not, reliant on one particular industry like oil exports. So Canada, for example, has a less diversified economy than the United States. We're heavy into natural resources and energy, much more so than the U.S. as a percentage of our GDP. So when we have a recession, we tend to have deeper recessions than the U.S. And the degree of integration, this is how integrated you are with the rest of the world. So take North Korea, very low level of integration. In fact, no integration, maybe a little bit with China. Whereas if you take countries like Japan, the UK, the United States, they're integrated because they play on a global stage. And the economy's growth potential. The size of the informal economy, this is important as well because it's difficult to collect taxes in the informal economy. So Greece is a good example of a country with a large informal economy, which means transactions are occurring, but they're not occurring on the record. So they're not taxable transactions. So if you have an economy where 20% of it is informal, that means there's 20% of transactions that are not going to be taxed to some degree. The larger that informal economy, the harder it is to collect taxes, even though the sovereign has the ability to collect taxes. Also, the higher the tax rate goes, the more you push people in to the informal economy. External status. This also ties in with the level of integration. International trade. Capital flows, your Forex policies, if you have a freely floating currency. And we're assessing all of these in terms of the ability to service debt. Also under external status, reserve currency status, which the U.S. has reserve currency status. There are a few others that come very close to that, the Swiss franc, the Japanese yen, the euro, probably I'd put that in fourth place. Fully convertible and frequently held by foreign central banks and other investors in the form of foreign currency assets, stocks, and bonds. So there are U.S. dollars all over the world. And when banks are holding these, especially central banks are holding these, they're not holding them in just dollar bills sitting on a shelf somewhere. They're actually holding them in treasury securities, in assets that are actually producing a U.S. dollar cash flow. Having a reserve currency status or a currency that approaches reserve currency status, meaning that it's frequently held by central banks and other investors, increases the ability to access a foreign investor base. For frontier and emerging economies, typically these economies have some type of Forex restriction in terms of their convertibility, some form of capital control, in either a limitation on money leaving the country or a limitation on money entering the country. The currency has a lack of convertibility, so that raises the risk of their ability to service their debt. Quantitative factors to look at, well, these aren't companies. We're not going to see balance sheets. We only have economic data, and economic data, depending on the country, varies in terms of quality and timing. And even among, let's just take G7, lacks comparability across countries. So if you look at the US and you look at Germany, for example, and you're looking at CPI, different weightings in the basket of CPI. Also in the US, consumption makes up about 70% of GDP, whereas in Germany it makes up about 50% of GDP. So it is a lower component of GDP. And CPI is the consumer price index, which is where it would show up in the C component of GDP. If you have different weightings in the basket, then you say, well, 5% in Germany, is that comparable to 5% in the US? When the US has a much higher weighting on certain things and Germany has lower weightings, again, even if they count it the same way, even if they use the same system and they use the same index methodology to measure CPI, just the components of the basket, the weightings of the basket, and the composition of GDP made up by the consumer makes it difficult to compare. Okay, let's look at a bunch of quantitative measures here. Under fiscal strength, we'll look at the first column here. We have debt burden, debt to GDP. general government debt to GDP. And here it's important, if you're measuring debt to GDP, to remove the debt held by the central bank. So you have a central bank and you have the Treasury, right? And the Treasury has the debt. The Treasury is responsible for issuing debt. So if you want to know how much money the government owes, you say to the Treasury how much debt is outstanding, they'll tell you. But some of that debt is held by the central bank. Well, they really just cancel out. It's not really debt. It's debt held by itself, in essence. Even though the central bank is independent from the government, it is part of government. So you can usually just cancel those two debt levels out, and you're looking at that net debt amount. Debt to GDP. There's debt to revenue, which is the general government debt divided by government revenue. And for government revenue, you can really just take nominal GDP and multiply it by the average effective tax rate for the economy. Well, let's say that's 28%. So you can see how government revenues can increase if GDP increases without the government having to raise tax rates. So economic growth is just great because it provides higher streams of revenue, but with economic growth, it doesn't necessarily mean that your debt grows. Let's tell that to the U.S. Treasury, though, because I don't think they get that. Actually, let me take that back. Let's tell that to the U.S. Congress, because I don't think they actually get that idea. Another measure that's important, and I put it here, it's not in level 1, but I put it here because you will see it at level 2, is either the surplus to GDP or the deficit to GDP. This is a measure of fiscal discipline. And when we're thinking about, well, what does all this mean in terms of a credit rating? You have this over here, government debt to revenue. Let's see if I can get something that writes on that screen here. Government debt to revenue? No, let's try that again. There we are, government debt to revenue. So anything under 100% has the highest credit rating. The higher your debt is to revenue. So if you owe $6 trillion and government revenue is $1 trillion, you're up to 600%. You might have much lower credit rating. Government interest payments to GDP. And you can see here again, if your interest payments represent as high as 30% of your GDP, that is not sustainable. Whereas if you're somewhere between 5 and 10%, AA to A, you are investment grade. Economic growth and stability. Here we're looking at real GDP growth rates and real GDP. When we say size of the economy, GDP in PPP terms, that's purchasing power parity, which is just real GDP. And now this is a level, the level of real GDP, so like 24 trillion. Whereas this is a growth rate, so year over year you might have 2.4% real GDP. What we say when we say 2.4% real GDP, we means the economy produced 2.4% more stuff, whether it be services or goods. It produced 2.4% more stuff, so that it removes the effect of price. Because you can have GDP decrease, you can sell 2% less stuff, but if you sell it for 4% higher prices, you'll actually have GDP look like it increased 2%, but from an economic perspective, the level of economic activity decreased by 2%. So that's why we use real numbers here. And then you have the, for real GDP, you have the volatility of real GDP. You will find that when you're looking at this, and I'm just going to erase something off the screen here so that I can do some writing. When we have growth, and here is our GDP, real GDP growth. If you have a low level of GDP growth, you'll have low levels of volatility. As you get higher levels of GDP growth, the volatility tends to increase. That is what is referred to as level-dependent volatility. So the lower the real GDP growth rate is, the lower we will see real growth volatility. This is the level of real GDP on this side. And again, if you multiply that by the effective tax rate, I'll just put T here, you'll get government revenue. And then what I think is going to be an important number going forward, especially for developed economies that have unfavorable demographics, is per capita GDP. This is GDP per person. When I say unfavorable demographics, you get an aging population and sometimes you get a shrinking population. And if you have an aging population, they tend to spend less. And if you get a shrinking population, well, there's less people contributing to GDP, such that you'll find that our GDP growth will be negative in these economies, and the level of real GDP will be dropping. However, you could also have a situation where GDP per capita is actually increasing, such that the quality of life is actually getting better in these countries when you measure growth on a per person basis, as opposed to measuring the level of growth, because if you have a population that's shrinking, it only makes sense that your GDP levels are shrinking, your GDP growth will be negative. And if we only focus on that, both the central bank and the government think that there is a problem to fix. You have to focus on GDP per capita, because conditions for a shrinking population might just be getting better and better and better, in which case there's really no problem to be fixed except the fact that our population is shrinking. Okay, our third factor under quantitative factors, external stability. And this will depend on whether foreign investors are both able and willing to hold assets in a country's currency. So take a country at random. Are foreigners able to hold assets of that particular country? Some countries disallow that. So there are some countries that say on our stock exchange is only domestic investors that can engage in our stock exchange, no external or foreign investors can invest through our stock exchange. A number of ratios for external stability deal with currency reserves and the level of external debt. Level of external debt is important, and I'll explain that in a second, but let's deal with currency reserves. It is a measure of liquidity. The first one we look at here is the amount of currency reserves to GDP. And currency reserves are this. The central bank is holding currencies of other countries. How does a central bank get that, by the way? So let's, might be worth exploring that. So let's take an economy, and we'll put a couple of businesses inside this economy right here. And they're importing some product into their country. Or actually, instead of importing, let's have them export out of their country. And since they're engaging in international trade, most international trade is denominated in a large currency. Either it's denominated in the euro, the yen, or the US dollar. So let's say it's denominated in the US dollar. So they sell something and they're going to get US dollars. Well, this business needs its own domestic currency because all of its expenses are in its domestic currency. So it goes to the bank and it sells its US dollars to its local bank and it gets its currency. But this bank over here doesn't want to hold on to those US dollars. It doesn't want any currency risk. So it sends it up to the central bank and it gets replaced with currency. So the central bank ends up collecting all of these different currencies. And that's how you get FX reserves. So the amount of excess reserves to GDP gives you an idea of the liquidity that that particular country has if it has to do things like defend its currency or it has to meet any kind of external debt. The reserve ratio is FX reserves to external debt. If you have, let's say, $2 trillion, well, that's a lot for a small country. Let's say $500 billion in external debt. In other words, the government issued bonds not in its own currency. A country that has its own currency issued bonds in US dollars. Well, it's got to pay it back in US dollars, but it can't print US dollars. So our assessment of whether or not it can meet that obligation is the level of US dollars it has sitting within its own country that it has access to. And that is the reserve ratio. External debt, the long-term external debt to GDP. And again, external debt is any debt that the government has that is not in its own currency. So some countries will issue debt in euros, some country will issue debt in US, even though their currency is neither one of those two. And then for a shorter term measure, we have external debt due in 12 months to GDP. Emerging and frontier markets. Commodity exports generate the bulk of foreign currency reserves, so part of assessing the creditworthiness of those countries is kind of projecting the price of where that commodity is going. So commodity prices can be a primary factor driving sovereign creditworthiness. Okay, let's move to non-sovereign credit risk. We should be familiar with most of the language here. Government agencies, quasi-government entities, very similar credit risk to the sovereign because these agencies come with either an implicit or an explicit government guarantee. Government sector banks and banks set up for development financing, similar to agencies in terms of credit rating and guarantees. Supranational issuers. These are established and owned by more than one sovereign, such as the World Bank. Regional government issuers, provincial, state, and local. This is where most of the attention is paid to in this section. They issue municipal bonds. That's the terminology used in the U.S. Outside the U.S., they're called local authority bonds. Some will have the same credit rating as the sovereign. Others are rated separately, such as in the U.S. Regional governments can issue what are called general obligation bonds or revenue bonds. General obligation bonds, these are the least credit risky of the two between general obligation and revenue bonds. They're unsecured and backed by the general revenues of the issuing non-sovereign, so they are supported by taxing authority. Credit analysis will treat the region as a mini economy without, obviously, broad fiscal or monetary authority. Revenue bonds are issued to finance a specific project, so that's a lot of project analysis here. Higher degree of risk than go bonds because you have cash flows from a single source. The credit analysis will focus on the viability of the project. A key metric here is the debt service coverage ratio, which is the revenue that is expected to be generated from the project divided by obligation payments, and this is your interest plus principal. It is very common that these bonds have a sinking fund provision, so they are not amortizing bonds, yet your annual obligations will include some level of principal, that being the amount of the sinking fund that they would meet each year. Question is, well, how do you estimate the revenue? I mean, if it's a project, let's say it's the building of a 6-lane highway, near the city, that you can attract more traffic through the city, and that the city seems more viable as a hub for manufacturing or warehousing. How do you judge the revenue? Well, then you would have some estimate of the increase in economic activity in the region, and if you have that idea of what we'll call it economic activity, remember, you can multiply it by whatever the effective tax rate of the region is, and that would give you the revenue for that particular project.